Businesses and their owners want to report as much revenue as they can, because revenues help increase stock values and are a large measurement of the health of a company. It's no wonder, then, that revenues are one of the highest areas of financial statement fraud. To help set guidelines for how businesses should report revenues, GAAP includes what is known as the Revenue Recognition Principle. The Revenue Recognition Principle states that businesses should not report their revenues until after a sale is both realized and earned. A sale is considered realized when a vendor receives cash or a claim to cash, like an accounts receivable, from their customer. A sale is considered earned when ownership of a product is transferred or the service provided is complete. Only when these two criteria are met can a business report revenues on their income statement. This concept of recording revenues and expenses when they are earned and not necessarily when cash is received is known as accrual accounting. Accrual accounting is the standard for generally accepted accounting principles. In a perfect world, a customer would always pay for their product or services immediately when the sale takes place or the service is complete. But the real world of business is more varied. It is very common for a sale to be earned at a different time than the cash is received. Let's look at a few different scenarios where the timing differs and see how they are accounted for using the GAAP Revenue Recognition Principle. For our first example, let's imagine that our customer purchased a product for $50 and immediately paid cash for that product. This is a common scenario in the retail space. Because the cash was received, making the sale realized, and the customer left with the product, making the sale earned, at the same time, the Revenue Recognition Principle allows us to record the sale on our income statement immediately. The journal entry in this situation would be simply to debit cash and credit sales. Now, let's imagine that the customer purchased the product for $50 today, but doesn't actually pay for it until next month. This is very common in the wholesale space or when working with recurring customers who make large purchases frequently. We know that the sale was earned since ownership of the product transfers to the customer. But has the sale been realized? Even though the customer has not paid yet, the sale can still be considered realized because the customer has committed to pay in the future, so our business has the right to claim that cash at the future time. Since the sale is both earned and realized, the Revenue Recognition Principle allows us to record the sale on the day the product changed hands, even though the cash isn't here yet. To record this transaction as a journal entry, we would still credit sales, but we can't debit cash because we haven't received it yet. So the debit goes to accounts receivable for now. This is often known as a sale on account since it is recorded to accounts receivable until paid. Later on, when the customer does pay the amount owed, we wouldn't record a sale again since it was recorded previously. Instead, we would debit cash for the money received and credit accounts receivable to reduce the amount the customer owes us. In our last scenario, let's imagine that the customer wants to pre-order a product that won't be released until next month. To reserve their spot, they pay for the product today. In this case, the sale is realized because we have received a cash payment, but is the sale earned? In this case, the sale is not earned yet because the customer has not received the product yet. Since transfer of ownership has not taken place, we can't consider the sale earned. So revenue recognition rules won't allow us to record the sale on the income statement until the product is delivered to the customer next month. But we still need to record the cash payment that was made. In this case, our journal entry would include a debit to cash to record the cash received. But we can't credit sales yet. Instead, we will credit a special account called Unearned Revenue. Unearned Revenue is an account where we can temporarily hold the sales until we are able to record them on the income statement. Unearned revenue is considered a liability account because we will owe the prepayment back to the customer if we never ship them the product. When the product does ship to the customer, that makes the sale earned, and the Revenue Recognition Principle now allows us to record the sale on the income statement. To do this, we would debit the unearned revenue to reduce it, since the revenue is now earned, and credit sales to recognize the sales earned. These are just a few examples of the complexities of revenue recognition. Correctly recognizing revenue at the appropriate time is an important part of ensuring the accuracy of a company's financial statements and ensuring that the statements are following the generally accepted accounting principles. To learn more about GAAP rules, revenue recognition, and other accounting topics, check out more of my videos on YouTube or visit ToryNorman.com.